Hello and good morning, folks. Welcome back to Almus Market Mornings with Shikhar Garg. And it's an unusual day with Mumbai observing rains in the month of March, weirdly. But it isn't unusual for the financial markets to drop or put on hold certain narratives or an even hotter narrative. And yes, we are talking about the SVB saga. Although the US Central Bank was there to protect the depositors of SVB, and HSBC also came to their rescue, the 2 year yields saw a phenomenal drop, more or so expecting no more aggressive hikes by the central bank. But what everyone kept aside was the inflation. Inflation expectations for the US, even though it's on the lower side for this month, it is still one of the key considerations for the central bank. And we also saw the release of Indian inflation data, which was at 6.44% versus the 6.52% in the previous month. So, Jacob, what do you think? Will the SVB saga affect the Fed rate hike aggression, or will we continue to see the aggression in Fed with respect to the rate hikes?
Yeah, good morning, Shikhar. Let me begin by saying that the last happenings of the last few days in US banking sector actually should not be a surprise. With the rates moving from 0 to 4.75 in less than a year, something was always going to give in. It was never an if, but when. Financial institutions who did not follow the basic risk management process of hedging their mismatches provided the trigger for the collapse in market sentiment and fears of a large contagion. Now, the market appears to be signaling that the steps taken by the Fed to end the banking crisis are not enough. And some of the US regional banks were clobbered again on Monday, with the First Republic falling nearly 80% up. Now, the reactions in fixed income market has been staggering, to say the least. The 2 year falling from a high of 5.08 last week to 3.93 erased all of its gains of the last 4 months. From a technical set point, it looks ugly with limited immediate upside. However, any quick reversal of these risk aversions can change the picture quickly also. The reactions in long tenors have been somewhat less, and that has steepened the yield curve. So the 2 to N yield curve, which had inverted to minus 115 not many days ago, is now less than minus 50 now. Now, having seen such a massive reaction in the markets, it's down to guessing what the Fed would do in the coming meeting next week. So unless we see a major meltdown in the coming days, I feel Fed would raise rates by 0.25%, which also will be an exercise in maintaining their credibility. But there are analysts who are calling for a pause, some even going to the extent of a cut. But I think that's all down to how things evolve in the next few days before the Fed meets, actually. That could possibly be the last hike in the cycle, according to me, if they do 0.25, meaning that they are likely to pass and await how the current turmoil reflects on the economy in terms of employment, consumption, and eventually inflation. So from this perspective, even if today's inflation number comes higher than expected, it would not matter. But a softer number would encourage doubts further. The Fed has been aiming to tightening conditions to cool the economy. Now the Fed's job has become a bit easier in this regard, and with banks expected to do the heavy lifting. So one more view that's emerging is that probably instead of pausing on the rates, Fed would take a pause on their QT. So it's really many possibilities that are looking ahead for the policy matters. Now, as per the market discounting, the rates for the cycle are expected to end at that is 4.8 back to 4.80 for this year, which means that there is almost a cut that is being priced in by the market. On the equities, some of the rate-sensitive sectors are recovered due to big fall in yields, but the finance sector was targeted for more selling by investors. Measures by authorities have so far prevented run on the bank deposits, but have not been enough to avert a bank run by the investors. So it's clearly a demarcation between the approach between the depositors and the other investors. The risk of financial crisis definitely remains, and the investors have rushed to reduce their risk exposure to the sector. The KBW Bank Index is down 12%, and it's the biggest decline since the pandemic in March 2020. And there have been several regional banks that fell more than 20% on the day, apart from the First Republic Bank, which I mentioned earlier. Now, central bank's credibility is definitely on the line. While European officials have rushed to say that their banking system is safe, there are arguments that call for ECB also to adopt a slightly conservative approach of going for 0.25% hike. Now, again, this is also something that they will have to decide going by what happens in the next 2 days, because ECB is meeting on this Thursday only. Overall, the USD is weaker across the board as the lower yields have impacted, and obvious big gainers were yen, Swiss franc, and gold. And even the Chinese yuan, which had weakened due to US yields going up, has reversed since yesterday. Now, come back to the peculiar currency of our own INR. While most EM currencies posted gains yesterday with a dip in US yields, USD INR was back above 82. The short-lived dip below 82 and bounce back actually brought in more importers and even the traders who were looking for a much deeper fall in the pair. So from a technical perspective also, inability to hold below 82 has dented any near-term bullishness for the rupee. In fact, it was a day of stark underperformance for the rupee. The CPI, of course, showed a mild moderation from previous month, from 6.52 to 6.44, although the market had expected a much larger drop. What is important is that it continues to hold above upper end of the RBI's mandated range, which is between 2 and 6%. High level of food prices hardly budged, throwing headwinds for policymakers who would be concerned with the worst combination of possibly moderating growth due to global factor and domestic high inflation. So there is no change in expectation of another 0.25% as far as RBI meeting in April is concerned. But as far as the rupee is concerned, it's really down to the flows, and flows have turned negative in the last few days, and with the CPI number also not coming to encouragingly, rupee bears are in control, but we can probably have it change in this attitude if today's scheduled trade balance figure posts another fall in the balance or in the deficit. So it's a combination of domestic challenges as well as the global environment that is guiding the rupee. Amidst all this, what could be heartening bit for the rupee bulls would be a good fall in the crude prices, which is now trading near $80. Thank you very much. Have a good day.
Okay, wonderful, JK, and thank you so much. That was quite good. And yes, folks, I'd like to actually begin by what one of our very close friends, Mr. Arvind Chari, mentioned in his commentary today. India is stirred but not shaken, just like James Bond likes his drinks, and more so because of the kind of activities that we are seeing in the financial markets. It is bound to be that India is still a resilient factor when it comes to economic performance. And even though the flows have turned negative, like JK mentioned, today's trade balance can give us some sort of cue on the currency's path ahead. As of now, we've seen some bit of weakening for the Indian rupee, but it needs to be seen how the flows and the trade balance, along with the central bank, act with respect to its movement. On the other side, yes, the 210 yield curve for the US have steepened a bit, with along with the US banks being clobbered in the financial markets by the participants. But I really like the statement JK mentioned, where it was never an if, but it was an when the banks would falter with the kind of risk that they were taking along. So it needs to be seen whether the Fed comes up with possible hike or possible pause of rate hikes or a pause of QT, as JK mentioned. But as JK has been saying, there is good likelihood that we can see a pause after this 1/4 percentage point hike in the current FOMC meeting. That's it for today, folks. We shall come back again tomorrow with another round of updates. Thank you so much for listening.